Good evening, and thank you for joining us this evening for our next series of webinars. Tonight, we're going to be talking about retirement basics. Those of you that know me know that my practice is focused on financial planning and retirement planning for the most part. And one of the topics that continuously comes up when we're having meetings with participants in retirement plans, in addition to, working with individual clients on financial planning and so on, is again, focusing on the goals and objectives around retirement. This, for a lot of people, can be a moving target. So tonight, we're going to focus on a lot of the main points that will help someone achieve a very comfortable lifestyle in retirement. I'm going to share my screen now with the slides that we're going to be going through. Now, as part of our commitment to you with this whole process of going through the concepts of retirement basics, first thing is we're going to be giving you some sound financial information that is applicable to just about everybody. One of the other key factors is just helping you identify your goals. And at any time after this program, if you would like to come into my office or just have a simple phone call, we can have a conversation around what is going to be most appropriate for you personally. Now, just going forward here. There we go. So again, focusing on, when you look at what retirement is going to be for you, what do you see? I talk to a lot of people to try to close their eyes and really envision what this is going to look like. And for the most part, it's going to be different for everybody. So when you start to think about what retirement is going to mean for you, really think through what you might want to work at certain times. Maybe you want to travel a lot, spend more time with family and things along those lines. And that's really what this whole process allows us to do. And again, everyone's different. So don't think that the person next to you that you may be working with at this time, that, you should talk to them about what they're doing for retirement. Because again, it's a very personal item there. So when you start to go through this, we want three key items here to really look at when you're focusing on funding your retirement. First of the steps is really determining your needs. And we're going to also focus on developing an investment strategy and then also protecting your nest egg. And these are probably some of the key factors that we are always concerned about. Some of the factors that will influence your retirement income needs, retirement age. This can be a moving target for a lot of people. Everyone may be aware that at age 62, you're eligible for Social Security to start, but this is not the full Social Security benefits that most people would be eligible for. So again, considering what age someone is going to retire, again, will determine how much money they're going to require, in addition to the length of time that they're going to be in retirement. Again, projecting out how many years we typically will be in retirement and what those assets that you have, how long they have to last. The other factor is healthcare needs. As we get older, things start to happen physically within our bodies. And, again, we have to address those future care needs that, anybody that has had a parent or a relative as they've entered retirement and then health issues arise, you have to make sure that you're budgeting enough around that particular situation and have that money available to cover those costs and ultimately address those needs as they develop for that individual. Inflation is also another factor that we have to take into account. Nowadays, we're seeing inflation right now because of the recent pandemic that's averaging probably around 6%. This is a concern. Prior years, we've been averaging about 2, maybe 3%, depending on the year. So inflation right now, because of all the supply chain issues and so on, are creating a little bit of a headwind in the economy. And we're seeing this also reflected in how interest rates will also be changing in the near future. So this is also something that we really will touch on and address. And again, personal lifestyle and things along those lines. So let's talk a little bit about retirement age. Now, the earlier you retire, the shorter period of time you have to accumulate funds, and the longer those dollars will have to last. This is probably the most prominent statement here when you think about what age you really want to retire. In addition, we talked about a few seconds ago, Social Security, again, doesn't start until age 62. And then Medicare, the medical insurance that we all get provided as part of our retirement through Social Security, doesn't begin until age 65. So again, looking at those factors, really helps us determine what age is the most appropriate for retirement. Now, this was an interesting study that was done about 2 years ago, and it talked to people about what they were expected to work, expecting to retire at a specific age, and then what they actually did when they hit retirement. So in the first bar chart here, you're going to see someone that was before age 60, 11% of those respondents basically said they expected to work, continue to work till age 60. But in reality, about 33% of those people actually did retire. So it was interesting to see that disconnect there, that they were anticipating working, but they actually did retire before age 60. The next category was individuals between the ages of 60 and 64. Again, understating the fact that a lot of people thought they continued to work, but in reality, they actually, 37% of them did retire. So again, considering these factors of what they were maybe thinking was going to be the situation, but what actually happened, again, worked out quite different. And then at age 65, when we see a lot of people looking to retire, because that's when, again, the Medicare benefits kick in and people can start collecting Social Security at a little bit of a higher level. Again, depending on your age when you retire, some people are at 65 for Social Security, some are 66, some are 67. This is all determined by the year you're born. So when you look at your Social Security reports that come out every year, or if you log on to the system with Social Security, check what year they're projecting that you will receive full retirement benefits from the system. And again, the next group was age 66 or older. 47% of them expected to continue to work, but only 17% of those ages actually retired. So again, a little bit of a disconnect there that we were seeing in the survey based on what people thought was going to happen versus what actually happened in this situation. The next one is really, it breaks down by men versus women. At the age of 65, this is really getting into the length of retirement and also life expectancy. So at age 65, 53% of males are anticipated to live to age 85. 32% more are expected to live to age 90, 32% of the total. So again, you can see the needs here to plan around a long retirement, usually around 20 years or more. For women, it went a little higher. 64% of women are expected to live until age 85. And then only 43% were expected to live until age 90. So again, having these assets last long-term, 20 years or more into retirement is really what most people should be planning around. Now, healthcare needs are probably the biggest factor that we address here when we start talking about people entering at age 65 or older that will need specific funds to address those care needs that they may realize in those senior retirement years. It is anticipated that about the average couple will need about $270,000 to maintain their lifestyle for their needs with medical care and things along those lines when they get into retirement. So again, a lot of issues around that, depending on your overall health and so on. Again, these are some of the items that we can have a conversation around to really address what your specific needs might be. Again, everybody's different. Some people may live a very healthy lifestyle and not anticipate to need $270,000 for that purpose. But again, others may not, and they may have some health issues as they head into retirement. So again, having your eyes wide open and understanding what these potential costs would be is very important at this stage. And again, you can see some of the differentials of healthcare costs versus general inflation. Healthcare inflation is probably one of the biggest factors that we're dealing with overall in the economy. As you can see here in 2019, the statistics were inflation for healthcare was actually about 4.6% versus the rest of the economy, which was at 2.3%. So again, just looking at these numbers and seeing where some of these issues can arise, you can see the need for planning around it and making sure that you have adequate funds for these types of healthcare needs. Now, inflation, again, just in general, again, we're assuming an average of about a 3% inflation rate. Today's cost, for example, for a gallon of milk is about $4. Future costs 20 years from now, just assuming a 3% inflation rate, brings us to about $7.22. Haircut, $45, grows to $81. A pair of running shoes, $100, grows to $180, and so on. New car, $35,000 car today is going to cost you $63,000 20 years from now. So the importance of anticipating inflation within your savings to make sure your assets are growing above that rate is extremely important. Now, lifestyle really is probably the biggest factor, and your cost of living. When we look at different individuals, some people live well below their means. So in that situation, in retirement, they may need only to replace about 70% of their pre-retirement income. But if someone lives a little bit more extensive lifestyle, they enjoy the better things in life and like to travel and enjoy themselves, they may need to replace at least 100% of their income in retirement. So again, everybody is different. Retirement should be whatever you want it to be, but it has to be really based around your expectations, as we discussed before, and setting the goals for how you want to live at that time. Now, the income sources that we generally work with, Social Security, as we were talking about before. Then we have savings during employment. That could be, again, earnings from, just in general, your wages that you receive while working, and then savings. Maybe at work, they offer a retirement plan that you're contributing to, or personal savings outside of a retirement account that you're accumulating funds for this purpose. Again, every person's going to be a little bit different, but these are the general three basic sources of income that most people are utilizing. Now, Social Security is estimated to replace about 40% of the average person's income at age 65. Right now, the estimate in 2021 was an average per worker of about $1,500 a month of benefit that they would receive. Now, one of the things that I will stress here, for those of you that have not gone on and looked at your Social Security statement in a couple of years, they stopped mailing them to certain groups a while back. So most people have to log on to the system to view their account. The website is ssa.gov/my-account. Basically, when you log in there, it will show you all of your prior years of contributing to the system, but it will also tell you what your benefits will potentially be. But one of the things you have to be concerned about with Social Security, on those statements that they provide, you will see clear language. And the last one that I read was that in approximately the year 2033, the Social Security system will only be collecting approximately 75% of the obligations they have to pay out for retirement benefits to the general public. So this effectively puts Social Security in an illiquid mode. Basically, they don't have enough money to spend to distribute assets out to everybody that they're obligated to. This has been an ongoing issue. The government knows about it. They have been funding the Social Security system with IOUs and increasing the budget balances that they maintain. But the reality is you really should not depend on Social Security to be your sole source of income. As I mentioned earlier, it only is anticipated to replace about 40% of your pre-retirement income. If you had to rely on $1,500 a month for your income needs in retirement, that's a little over $18,000 a year based on these numbers. You can't live too well on that source of income. So having personal savings is probably the most critical item that you can anticipate. The other item is that 74% of workers are anticipating continuing work after reaching retirement age. I personally experienced this with my father. He turned 65. His whole purpose in life was he enjoyed his work. So he continued working for the people that he was involved with at the time, and he didn't retire until about age 74. He decreased his hours to more part-time and things like that, but this was a personal commitment for him. He enjoyed getting out there. It gave him a sense of purpose, social aspects, things along those lines. In addition, it also gave him a nice additional cushion of cash for income that he didn't have to rely on his other savings too much at that point in his life. And 27% of retirees say that they have worked during retirement, again, just to support that lifestyle. So again, as we get older, retirement is different for everybody. So based on your individual goals and objectives and what savings you may have accumulated up until that point will determine what your path forward will be with that. Now, talking about personal savings, tax-deferred vehicles like work-based retirement savings plans, things along those lines, IRAs, annuities, these basically on a tax-deferred basis will allow your money to grow without paying income taxes on that growth every year until retirement, when you'll be ready to take that money out. Then they have taxable vehicles. This would be like individual savings accounts, investment accounts, things along those lines. A lot of times those are funded with stocks, bonds, or cash alternatives like CDs, things along those lines. And then you also see mutual funds and exchange traded funds, the ETFs. These have also been a very popular source for investments for people to diversify their portfolios amongst. Now, we're going to talk about a little bit of the benefits of a taxable investment versus a tax-deferred investment. And this chart simply assumes that an individual invests $10,000 and they're earning a 6% annual rate of return, and they're about a 24% tax rate, which is about the average out there in the economy. So on the tax-deferred investment, remember, they're not paying that 24% tax rate every year on the growth of that 6% each year. You'll see here that $10,000 after about 30 years grows to $57,435. Conversely, the taxable investment, the green line, grows to only $38,104 because every year you are paying 24% in taxes on that 6% growth that account was earning over those years. So again, the value of utilizing a tax-deferred account versus a taxable account are quite substantial. And if your employer offers a 401k, a 403b, simple IRA, something like that, I encourage everybody to really take advantage of that and participate at the maximum level. The tax-deferred investments generally will, again, be available to you later in life after 59 and a half, when the IRS allows you to start withdrawing them without penalty. Taxable investments, we can access those dollars at any time. But again, this should be more savings oriented towards maybe providing some additional liquidity for your lifestyle and things like that prior to retirement. Now, the work-based retirement plans, again, pre-tax or post-tax contributions, depending on the situation. Again, tax-deferred accumulation. Sometimes the employer will provide a matching contribution to the plan to give you as an incentive for you to continue to save. And then again, annual annual contribution limits are much higher than a standard IRA contribution. So as you'll see here, for the year 2022, this past year, the IRS increased the contribution limits for a 401k or 403b plan. You can now, if you're under age 50, contribute up to $20,500. If you are over age 50, you can contribute an additional $6,500, giving you a total of $27,000. If you are in a simple IRA plan for 2022, that limit has increased to, if you're under age 50, up to $14,000 in savings, and then an additional $3,000 if you're over 50 to bring you up to $17,000. Again, whichever option is available to you, you should make sure you're taking full advantage of that. And again, if your employer is matching that contribution, you should be putting in at least the amount of money that requires you to get 100% of that match. So for example, if an employer is saying to you that they will match dollar for dollar up to the first 4% of the wages that you contribute to the plan, you should be putting in at least 4%. Again, we want you to be able to continue to live a comfortable lifestyle before retirement. So you have to make sure that you're able to cover your bills and expenses. But that is probably one of the biggest factors that we see that people aren't taking advantage of, especially if your employer is providing that kind of a match. But even if they're not, the nice thing about a work-based retirement plan is the fact that it makes it very easy for you to save money. Realize the money is deducted from your payroll automatically every pay period. So when that money is deducted, it gets immediately deposited into your retirement savings account, whether it's a 401k, simple IRA, and so on. So again, the convenience factor is there, the tax deferred accumulation, and the high contribution limits are probably your most important factors to consider with a work-based plan. The next is Roth contributions. Now, a lot of 401k plans now have a Roth feature available. And the nice thing about Roth is, first of all, you're not getting the tax deduction for the contributions, but when your money is invested and growing within a Roth plan, it grows tax-free when you go to retire and distribute it in retirement. So let's say you invested money, and going back to one of the prior examples, and you put $10,000 in and it grew to $57,000 because you didn't pay taxes on it over the course of 30 years. Now you go to withdraw those funds, you're not going to pay taxes on it because the original $10,000 that you deposited was done after taxes. It's a nice arrangement to take advantage of. Within the 401k world, there are no income limits that stop you from contributing into a Roth. We're going to talk about Roth IRAs in a little bit. Those do have certain income limitations that you will have to adhere to. But again, the Roth contributions, you must hold them for at least 5 years and reach at least age 59 and a half. Again, the distributions are not taxable. So that's a nice benefit of the Roth, and so on. Now, a traditional IRA, again, these have been around for decades. The nice thing about a traditional IRA is the limits for 2022 are $6,000 if you're under age 50. Over age 50, you can put in up to $7,000. You can get these types of accounts at any bank, investment firm, mutual fund company, and so on. So their eligibility is broad-based. You get the tax deduction dollar for dollar for the entire amount that you're contributing to the plan. You get tax deferred accumulation. Again, we have investment choices from stocks, bonds, mutual funds, exchange traded funds. You can put it in a CD in the bank, things along those lines. There are the limits, like I just described, that's $6,000 and $7,000 for someone over age 50. And at the age of 72, you are required to start taking money out of a traditional IRA, even if you are still working. Now, that is a little different from a 401k, or what we call a qualified plan that's offered through an employer, because when you are still working and participating in a 401k, you do not have to take the required distributions until you are retired and not working anymore. So just keep that in mind when you start to think about when you're going to retire and when you're going to start needing to take money out of these accounts. As I mentioned before, the Roth IRA, same contribution limits as a traditional IRA, $6,000 and $7,000 if over age 50. But these are after-tax contributions. So realize if you're looking to put into an account $6,000, you will have had to probably earn around $8,000, pay the taxes on the $8,000, netting about $6,000, and then making that deposit into the account. Again, tax deferred growth, and if you, when you retire, you go to withdraw the funds, the withdrawals are tax-free. There are no required minimum distributions for the individual that is making the contributions to the account. Now, if you are a beneficiary of a Roth IRA, just like a traditional IRA, you will need to start taking out distributions, usually within the first 10 years after inheriting that particular account. Again, annual contribution limits, the 6,000 and 7,000. And there's income eligibility phase outs with a Roth IRA. I touched on this briefly before when I was talking about the Roth 401k features. Generally, right now, I believe the Roth limits for a single individual is 150,000. So if you are making over 150,000 as an individual, you will not be able to contribute to a Roth. If you are making about 195,000 for a couple filing jointly, you again would be prohibited from contributing to a Roth IRA. Annuities are another option. Now, generally, annuities are a great option if you want to save money in excess of what you're putting away in a traditional IRA or your employer-sponsored retirement plan. Contributions into annuities are always after tax. The money then gets invested, and there's a couple of different options when you can talk about what options are available for the investment, but the growth in the account is tax deferred. There's no contribution limits. There's no mandatory minimum distributions, and some of the plans will provide a guaranteed return, whether it is guaranteeing an income stream to you when you are in retirement, or if you're using a fixed annuity, a guaranteed interest rate for the growth of the account each year. And again, looking at these, again, talking about the fixed account, again, generally a fixed annuity every year on the anniversary of that particular contract, the annuity company would provide you with the interest rate that they're going to be paying you for the next year. Pretty straightforward. The variable annuity, this basically invests in mutual funds within the annuity. They call it sub-accounts. And what the mutual funds generally provide is a full diversified portfolio between stocks, bonds, other types of cash alternative investments, things along those lines. They offer managed programs, and some will be indexed. Again, a lot of options in the indexed world. These I find are probably the best vehicle to provide upside growth within an annuity vehicle. Indexed annuities are actually very popular also, again, tying into specific indexes like the S&P 500, the Barclays Bond Aggregate, things along those lines. Basically, the annuity contract will invest in a portfolio of investments that will track with the index. They also offer certain guarantees that you may not lose money, or there's a certain buffer or a downside protection that they will provide in the contract. Again, every annuity is a little different. They are very popular. We use them to supplement clients with their fully funded retirement plans and so on. So I encourage someone to really think about these as an option going forward. Again, they're not the right fit for everybody. Some advisors out there try to sell annuities to everybody. That's not appropriate. So just be aware when you go sometimes to some banking institutions and so on, if someone is talking to you about rolling over a CD, and if they're offering you an annuity, just take a step back and say, is this my best option? Some annuities have very high fees, and that's one of the other concerns that would come up in the conversation when reviewing an annuity contract to make sure it's appropriate for you. Taxable investments, again, thinking about this, if you're maximizing your retirement accounts and you have extra funds that you wish to save and invest for the future, again, looking at the various options that are out there, they typically fall into three categories. You have stocks, bonds, and cash alternatives. And then all of these also flow into mutual funds and exchange traded funds, the ETFs. So if you're looking to buy a portfolio of individual stocks, this is very doable. Everyone's, able to open up an E-Trade or a Schwab account and buy and sell stocks or bonds all day long. Within those accounts, you can also buy mutual funds and exchange traded funds and so on. Realize the mutual funds, when you start thinking about how much money you're investing and how well that portfolio potentially is going to be diversified. The nice thing about a mutual fund and an exchange traded fund is each of them are like a basket of securities. Typical mutual fund has between 100 to 200 different stocks in the mix, or bonds, or a combination of both. So again, figuring out what is the most appropriate for you is based on your own personal risk profile. A lot of people get caught up in the idea of, wanting to chase the latest and greatest, investment option out there. We get a lot of calls on Bitcoin and the other cryptocurrencies, and that could work into this mix. Now you can actually buy mutual funds or ETFs that have them mixed into the portfolio, or you can go out and buy the individual coin if you like. Are they appropriate though for your personal goals and objectives? If anybody has been tracking the cryptocurrencies, there is a wide range of volatility that is in that sector. So again, high risk, but some people have made some very good money with that with a very high returns. You have to really look at all the risk factors when creating a portfolio. And we're going to touch on that in a little bit. So again, the three key factors to funding a comfortable retirement, again, developing that investment strategy now. So I talked a little bit a second ago about diversification and asset allocation. These are probably the two biggest factors when it comes to reducing risk in an investment portfolio. The other option is dollar cost averaging, and we're going to talk about that a little bit. This is typically how it works with a 401k or 403b plan. So we'll talk about that in a second. But now we're going to talk about a little bit about diversification. And again, the key with diversification in any investment is, again, trying to limit your exposure to potential losses in any particular sector of the market. And this is important. Realize we talk about, when we design investment portfolios, how the assets are correlated. So if you have assets that basically move together when the markets go up and down, those are correlated assets. And you typically don't want to have a lot of assets in your portfolio that typically move together like that. You instead want to have diversification, so that maybe when one sector of your portfolio is doing well, maybe the other one is not doing as well, and vice versa. One may do well, may not, and so on. The idea is when you have a diversified portfolio, you tend to limit your overall risk exposure. And again, asset allocation is really how we mix the assets to create that efficiency of returns versus risk in the particular portfolio. And again, this is different for every individual. I could have two 40-year-olds or two 50-year-olds sitting side by side, and I could ask each one of them specific questions to determine their risk tolerance. One could be conservative, one could be aggressive. Again, managing the risk in the portfolio determines how aggressive or conservative we are when we create that portfolio. So again, it has to be efficient, and it has to provide some of that downside protection on the overall mix of the assets. Now, considering your personal asset allocation model, really it goes through three factors. A, investment goals. How long-term do we need to save this money for? Your time frame and so on. Again, the investment goals could also tie around either savings for something specifically in retirement. Maybe you want to move to another state and buy a home somewhere, or you are looking for, a certain level of income in retirement. Also, the time frame, as I mentioned, the more time we have before retirement, the more money we potentially can accumulate. And again, risk tolerance, as I was just talking about, everybody is a little different with regards to that. And it's important to make sure that you are dialed into the correct risk allocation for your personal needs and goals. Now, talking about the various options here, this is a conservative model portfolio that we, would potentially recommend to a client that had a very low risk score. This is with someone with a 20-year time horizon. And what you may notice that the portfolio is dominated by a large chunk in bonds, about 50% of the account, and then cash alternatives, about 20%. The other assets, as far as the mix, would be about 30% in stock. Now, this type of portfolio over the years has averaged around a 6% return. But there have been some negative years. As you see here, the worst year this particular type of mix has had in the last 20 years was down about 12%. The best year was up about 18.75%. The average being 6. Again, this is an appropriate portfolio for someone with a very conservative risk profile. Conversely, if we go to an aggressive portfolio, again, similar time frame and so on, but they want to have really a lot of growth in the mix, 75% of the portfolio is going to be in stock. Only about 25% is going to be in bonds and cash at that point. Now, looking at the last 20 years, best year was about a 27% gain. Worst was a downside of about 27%. Average annual return has been in the 7% range. Now, someone may say, well, why would I consider, going that aggressive if the conservative portfolio is going to be more, only giving me a point below that on average over the course of 20 years? Again, when you start to think about that person's individual risk profile and their desire for certain growth, you have to allow for a greater allocation to stock. Maybe that portfolio doesn't have 75%, maybe it has 60%. That's what, sometimes you may hear people talking about that 60-40 model, 60% in stock, 40% in bonds and cash, or some other alternatives. So again, it could be anything that individual thinks is appropriate based on their risk profile. And again, that time horizon and so on. So keeping these factors in mind when you're creating an asset allocation model are extremely important. Now, again, looking at this over time, and again, the average returns annually within a portfolio, and again, we're going back here about 25 years. The average return in a stock portfolio has been about 9.5% on average long term. Corporate bonds are averaging about a 6% return, and treasuries, what we call T-bills, average around a 2% return over time. But you can see where the extremes are here. You'll see on the chart here, 2008, that was the real estate bubble when it burst. Around the year 2000, going to 2002, that was the tech bubble. So we've had two major events during that timeline that had a 20% or more pullback on the stock market. But at the same time, if you looked at the T-bills or the corporate bonds, they did not pull back as dramatically. And in fact, a lot of times they offset some of those losses in the equity area because these assets are what we call non-correlating for the most part. Sometimes we see the bond market and the stock market decline. We saw this in 2008. If you look at the chart here, where it shows corporate bonds actually showed a little bit of a negative return in that period. And the reason for this was the financial crisis in 2008 was led mainly through banks with the extending of credit to the real estate market. So a lot of banks had issues on their balance sheet with underperforming loans and so on that they had to clean up. But the government stepped in at that time and made the banks whole. And you'll notice that, shortly thereafter, the bonds recovered and did actually quite well, returning about an 18 to 19% return. Stock market did a little bit better than that period, returning almost 25% in change during that particular following year. So again, considering all of these assets as part of the mix that any individual would look to allocate into. Now, dollar cost averaging, this is when someone is investing money on a fixed basis every month at regular intervals. This could be directly into a mutual fund. This could be basically in your 401k or 403b account. A matter of fact, as I mentioned earlier, 401ks and 403bs will typically have this feature automatically built into them because the money that you're contributing comes out of your paycheck every pay period. So we know that most people are getting paid every week or 2 weeks and so on. So when money is withheld from your paycheck to go into your 401k or 403b, it automatically gets deposited right after that pay period. So in a sense, you are averaging into the market once, twice, 3 or 4 times a month. That is probably the best strategy long-term for savings that we can understand, providing the greatest level of return. It also provides downside protection in that your average cost basis within the investments that you're buying tends to be lower over the course of a year or 2 years and so on, because you are buying in at those various levels in the markets. So definitely a tremendous strategy that I encourage everyone to take advantage of. This slide talks a little bit about that if someone was doing an investment of $100 a month over the course of 5 months, and considering, let's say, they were buying an individual stock or an ETF or a mutual fund, and the share price ranged from $3 over that period up to $8, as you'll see on the chart, so again, the average cost at that time, basically, when you look at the various shares that they're acquiring, you'll notice in month 1, at $6 a share, they bought 16.7 shares. But month 2, when the price dropped down, they bought 33 shares and so on. So when you look at the average price versus the average share price, you'll see that there is quite a differential there. The average price per share was $5.20 versus the average cost per share when you dollar cost average at $4.65. So you definitely get an advantage there long term when savings are placed on a monthly basis, and again, taking advantage of the market conditions at those times. And again, the last item here that we like to talk about when someone is approaching retirement is protecting that nest egg. And a lot of that has to go on regarding how they're managing their savings. Are they, have they started early enough in life? Are they saving on a regular basis? And also preparing for some of the unexpected aspects of life. The first aspect of this that we should really address is the time dedicated to savings. So we have 3 individuals here. One started saving $3,000 a year, assuming a 6% annual growth rate, and again, reinvestment of the earnings and no taxes taken out. So that $3,000 invested per year at a 6% growth rate, by the time that individual from age 20 to age 65, they will have accumulated $679,500. Tremendous. Again, the value of compounding interest. If the next individual began saving that same amount at age 35, when they hit age 65, they're only accumulating $254,400. So again, a short 15-year difference in saving that $3,000 a year basically has reduced their retirement savings by about $430,000. So again, substantial difference there. Someone that starts at age 45 putting in $3,000 at 6% will have only accumulated at 65 $120,000. Now, going back to some of the previous slides, you'll notice that the government is allowing in 401k plans and IRAs people to do these catch-up provisions when they're at age 50 or above. The reason for that is we see a lot of people at age 50 that have not saved enough money for any sort of meaningful retirement. Some of the statistics that I've seen out there is that the average person at age 50 has only accumulated maybe $18,000 to $20,000 in total retirement savings. This is a tragedy. And again, talking about Social Security, people may be thinking that at age 65, they're going to collect a nice benefit at Social Security, so maybe they didn't have to save as much while they were younger. But the government, seeing this, is really trying to encourage people now to save money on a regular basis specifically for retirement. That's why you're seeing 401ks allowing that extra $6,500 going in, or an IRA an extra $1,000, and so on. So keep this in mind. If you have not saved enough or think you have not saved enough for potentially retiring, this should really light you up a little bit and make you say, maybe I should start considering saving more. We always try to talk people through how much they should be saving. Ideally, we look at a couple of budgetary aspects of this, and there's some basic rules that we look at that, say that 50% of your income should be used for specifically for your cost of living. 30% should be for the things that you want that are above your basic needs. And then 20% should be allocated towards overall savings, whether that is in with a 401k plan, IRAs, or even just general savings. But the problem is a lot of people will be living on maybe about 60 to 70% of their savings. And then you look at the disposable income on top of that, they tend to leave a very small sliver for retirement or future savings goals. So again, you have to step back and say, maybe I should think about paying myself first, putting money away into savings, targeting 10 at a minimum, maybe 20% if you can get up to there, if your budget allows it. But again, just keeping this in mind is so important. And again, understanding what you can commit to in savings based on your lifestyle and so on is extremely important. Rebalancing the portfolio. We typically will look at the portfolios that we manage on, probably about, a monthly basis, but we have it dialed into our computers here to really review everything on a daily basis. But as an individual, if you are not dialed into this, you should at a minimum consider rebalancing your portfolio at least once a year. One of the reasons for that is the fact that, realize if you had a stock or a bond investment within the portfolio and you wanted to maintain your ratios of maybe 60% in stocks and 40% in bonds, let's say the stock market has done very well that year. Let's say we have 10% growth. Now that stock component may compose about 66% of your portfolio. Again, exposing you to a little higher risk. So by rebalancing, you can bring things back into alignment. So again, you're maintaining that ratio of 60-40, 70-30, 50-50, whatever the appropriate risk and allocation is for your needs. Major lifestyle change. Someone may be going through some changes in life. Children may be out of the house. Maybe they've gone through college and they've gotten married. You may have been keeping savings allocated for them at that point. Now that they're not in the house anymore, maybe now you can rebalance your account and address that. Maybe there's a situation where someone has a divorce, things along those lines. Again, everybody's situation is different. You should just consider that when you have a major change, even if maybe you have a child that you're blessed with, then you definitely should consider rebalancing your portfolio to address what your needs may be going forward as your family grows. So again, looking at this at least once a year. I usually recommend quarterly, just to understand what's going on in the accounts. Sadly, most people look at planning their vacations more during the year than they do their investments, and specifically planning for retirement. So if you're one of those individuals, it's great that you like to travel and things like that, but just carve out a little time just to make sure that your portfolio is allocated appropriately. Again, at least once a year. Quarterly would be better. Now, preparing for the unexpected. And this sadly, the last couple of years with the pandemic has brought to light a lot of situations with people sadly passing away due to COVID. Within my practice, I had several clients in their 50s pass away, and their situations with their families and so on. Sometimes they didn't plan to have this happen. No one really anticipates passing away early, but you have to plan around this. And sometimes tragedy does hit. So when you have a family, you want to make sure that things are taken care of. Life insurance is probably one of the first areas that we talk to people about. Provides a source of cash for loved ones, for all these unexpected expenses that may be associated. Maybe you want to protect a business, preserve your estate, pay off mortgages, provide a retirement income for your spouse or your children, pay for college educations. Life insurance can do a lot of things. Realize the benefit, the death benefit that is paid out to your beneficiaries is going to be used for the purpose of providing for all of the above that we just discussed. So if you don't have life insurance and you don't think you have enough saved overall to provide for your family in the event of your demise or something like that, I encourage you to take a look at it. Term life insurance is probably one of the best options for buying inexpensive protection for these purposes. I encourage everybody to consider that. But life insurance comes also in a lot of different flavors, as I like to say. There's whole life, universal life, variable life. Those other types of contracts generally have a savings component built into them. I sometimes call it a forced savings. You will pay higher premiums for them, sometimes 3 to 4 times what the cost would be for the basic term insurance. But you will find after about a 10 to 15 year period, not only have you had insurance for that timeline, but the policy starts to break even with the money that you've invested in it, and it begins to continuously grow thereafter. Again, there's so many different options that you can build into these types of policies. So I encourage everybody to really take a moment, think about what they have as far as coverage goes, and if this ties in with your overall plan for retirement and so on. Long-term care. This is probably the biggest component of that $270,000 that I had mentioned that people will need in retirement to fund unexpected medical situations as they pop up. Everybody will typically have Medicare insurance and a supplement, but those contracts only provide basic benefits when it comes to long-term care. In fact, if you read through Medicare and any supplemental contract, typically you are just given for skilled care benefits that would provide you from 20 to 100 days, depending on the type of plan that you have and how much money you would be required to lay out of pocket. But after that 100-day window, you are basically on your own, unless you have long-term care insurance or adequate savings that can provide for the long-term care needs, should someone need some form of skill or custodial type care. I've seen this personally within my family. Some recent estimates from some just now with family members in Florida. The average nursing home down there for care is going to be averaging between $8,000 to $9,000 per month. If you're up in the Northeast here, where we're based, we typically see $10,000 to $12,000 per month on average. Some are even higher than that, depending on the type of facility, whether it's private or a Medicare or Medicaid types facility. So again, just understanding these situations are extremely important. Statistically, 65-year-olds typically have a 70% chance of needing some form of care. I think the numbers at age 75 are 1 in 2 people will require some form of assistance. Now, most people will start out in a long-term care situation in a home setting, whether it's a home care aide or nurse coming to the home to provide some basic care for them. But what happens is after a period of time, that tends to escalate. So as we get older, these types of situations do materialize. Again, understanding the costs that are associated with it and doing some basic estate planning can also help cover some of these costs. If someone is looking to qualify for a Medicaid assistance, you can move assets between spouses or put them into trusts to, again, provide for someone to look poor on paper so they may qualify for Medicaid. So again, just some considerations there, understanding those particular needs. Again, at this point, I want to say thank you very much for your time this evening. If you do have questions, feel free to shoot me an email, or reach out to us, give us a call. More than happy to walk through any of the portions of this slideshow that really talk to you, and maybe it's something that is concerning you at any given point. But I wish you all well. And again, have a wonderful evening and all the best in 2022. Take care.